I'm Nadia.
And I'm Nicole, and welcome to the Wealth Twins channel.
Today we're going to tell you how you can use Fidelity investments for early retirement.
We're going to go over the types of investments that you should focus on, explain some of our favorite early retirement investment strategies that you can use if you want to have the goal of reaching retirement before the age of 65.
We're also going to tell you about the FIRE movement and how you can calculate the actual amount of money you would need to retire and live life on your own terms.
Sounds good to me.
Now, if this sounds good to you and you want to learn more about it, then hit that like button and let's get started.
Now, if you've followed us for a while, you'll know that we both retired in our early 30s, and we use a combination of strategies to retire early. And one of the most important things that helped us was that we chose to focus on things like low-cost, high-quality investments that we can keep for the long term.
Yeah.
Concentrating on those low fees and high-quality investments led me to open up Fidelity's brokerage account, okay? Now, Fidelity made it pretty easy for me to open up both my individual brokerage account, and I was even able to roll over my retirement accounts so that I can easily manage all of them in one place, which was Fidelity.
Yeah, with a Fidelity account, you can have access to stocks, bonds, options, and everything in between. However, if you're looking to invest for early retirement, you should narrow your investment focuses to only those types of investments that Fidelity has that are designed to give you a good return, while at the same time minimizing your risks.
Now, these types of investments that we decided to focus on were actually a mix of index funds and ETFs that offer dividends.
Yeah, ETFs or exchange-traded funds are very similar to index funds, but they also have characteristics that relate more to stocks. Many people like to choose ETFs over index funds because you can buy it during stock market hours, just like you would buy a stock, and the cost that you get into the fund is the price that is quoted when you buy it.
Sometimes index funds have a minimum purchase requirement that may make the ETF equivalent easier to get into because it has a lower price. It's a great option to have when you aren't able to invest a large initial amount of money, and also you want to keep waiting, and you also don't want to keep waiting in order for you to invest.
Yeah. One ETF that Fidelity Investments offers that we find interesting and believe can be used for early retirement is FDVV.
Yep, FDVV is Fidelity's high dividend ETF. This ETF focuses on large and mid-cap companies that are expected to not only continue to pay, but also grow their dividends.
Yeah. Now, index funds are passively managed mutual funds that give you instant diversification and usually have smaller fees that you have to pay for management and trading activities.
Yeah.
Okay. One index fund that Fidelity offers that we both like is FZROX.
FZROX is Fidelity's zero total market index fund. It's an index fund that was designed to really reflect the performance of the whole U.S. equity market by having a good mix of small cap, mid cap, and large cap companies.
Yeah, although FZROX is a relatively new fund, it's a high quality fund that offers customers a chance to invest with zero minimum requirement and with zero fees for buying and holding it in your account. Normally, a customer would have to pay fees like management fees, transaction fees, and service fees, but not with this Fidelity product. It's one of the first of its kind, and it's helping Fidelity stand out from its competitors.
If you have never heard of FZROX and want to get our thoughts on it, we suggest you check out our video, 5 Things You Need to Know About FZROX, that we have linked at the end of this video.
Now, you may be asking yourself, thanks twins for letting me know about these index funds and ETFs.
It's all cool, right?
But how do I use these Fidelity investments for early retirement?
Well, you use these Fidelity investments for early retirement by executing an early retirement investing strategy. The early retirement investment strategy that we use and we like to focus around is focused around dividends and harnessing the power of those dividends as long-term buy and hold investors.
Yeah. Did you know that dividends are the only way to make passive income in the stock market, and their compounded growth is tax-free?
Say that again, Nadia?
It's growth. Compounded growth is tax-free. Now, if you don't know what dividends are, let us explain them to you. Dividends are cash payments companies make to investors just like you, just for holding the securities. Dividend payments are made on a consistent basis, usually every 3 months, and you can either choose to receive the payment or reinvest the money back into the company.
Yep. Now, when you reinvest your dividend back into securities that you bought, regardless if it's a stock, index fund, or ETF, you are able to grow your ownership position, which then also increases the amount of money you will receive in the next dividend. See, it's a nice little cycle.
Keep rolling over. Now, there are 3 different types of dividend strategies that we want you to know about and that you can use Fidelity Investments for them in order to execute each one of them, okay? The first dividend strategy that you can use for early retirement is the dividend growth investing, okay? Dividend growth investing is when you invest in companies that are mature enough to pay a dividend but are still in the growing phase of the business life cycle. Based on the earnings, the company is profitable, but right now the dividend they're paying out is still small. Okay. You invest in these types of companies because you believe they will increase their dividend payout in the future and their price of the company in the market will increase.
Yep. You're taking a bet in the future of this company. Now, for example, Apple is still considered a company that falls into this category. And guess what? FDVV, the ETF that we mentioned earlier, actually holds Apple.
Yep.
Remember, the goal of that Fidelity ETF is to buy dividend companies that are growing and are believed to keep increasing their dividend, okay? Now, another dividend investment strategy that can be used for Fidelity customers and that are interested in early retirement is high dividend yield investing, right? Now, high dividend yield investing is when you buy securities that have a high dividend yield compared to the securities market price. The low market price could be because the company is very mature and doesn't grow very much, but due to the nature of the business, it can provide a very high dividend that attracts buyers, right?
I like those.
You know, at the end of the day, dividend is income, okay? When an investor buys a stable, mature company that pays a high dividend, they are just focused on getting the income from that security.
The third dividend investing strategy that we believe you can start doing is using Fidelity Investments. It's called broad-based index investing. Broad-based index investing is when you decide to buy index funds that are based on the general outlook of what you think will happen in that sector or country. For example, you buy an index fund like Fidelity's FXAIX, which mimics the S&P 500 because you believe that the U.S. economy will continue to grow. Buying securities that mimic this index will get you a piece of some growth businesses, a piece of some mature businesses, and even some businesses that don't offer a dividend. You give up some of the upside potential of the dividend and the price appreciation, but you do not suffer a higher than average loss that you could have by choosing one of the other dividend strategies.
So you're really not making that much of a bet like you would in dividend growth investing.
Kind of in balance and
you're in the middle, broad based. Now that you know some Fidelity investments and some investing strategies that you can use to help achieve early retirement, the next thing you're probably asking yourself was, well, then how much money do I need to have in order to know that I can retire early?
Well, how much, Nicole?
Well, the answer to that problem was actually figured out by the FIRE movement. And they say it's all about your unique FIRE number. Now, if you don't know, FIRE actually stands for Financially Independent Retire Early.
Your FIRE number is a formula that can be used as a target to see how much money you need to have saved to no longer have to work for a paycheck and become financially independent.
That's the goal, guys.
The financial independence number formula is simple and easy to calculate. It is your yearly expenses multiplied by 25, okay? Why 25? Well, it's because 25 represents the amount of years you want to be able to cover your expenses without having to work for the money.
In order to use just your investments to cover your expenses, you should also be comfortable only taking out 4% of the money you have saved and living off of that amount for the next 25 years.
Knowing your FIRE number will give you a target, and then you can use that target to come up with a plan. Having a target and a plan is much better than just hoping and wishing that someday you can retire and only having a vague understanding of the actual ability you have to make that a reality.
Now, at the end of the day, when you're investing, you should have a specific financial goal in mind and use strategies that will get you there. We also believe that you can use a low-cost brokerage like Fidelity Investments and the index funds and ETFs that they offer, along with disciplined decisions to help you achieve early retirement before the age of 65.
If you found any value in this video, please show these twins some love and subscribe to the channel.
If you have any questions or anything just wasn't clear in this video, please send us an email at contact@wealthtwins.com. We answer all the emails we receive, and we'll be happy to hear from you guys.
And with that, we'll see you guys in the next video.